This video combines the two analyses on profit if trade is opened earlier or later and if trade is closed earlier or later. The analysis measures whether the payoff of your trades would have on average been better or worse in case your position would have been opened or closed earlier or later. The structure of the analysis is actually the same, however, the interpretation of the output may differ slightly. Therefore, let's first of all have a look on the analysis on the close timing. The closing of a position may have a big effect on your actual performance in trading, probably even more than the open timing. The position closing may enable you to get the most out of a trade. On the other hand, with the closing of your trade, you may also limit yourself for profit in case you stop your winning trades early or increase your losses in case you let your losing trades run. This is one of the major rules in trading, and your closing strategy have the highest influence on this. Without a question, the perfect timing is very hard to reach and oftentimes may even be purely based on luck if it happens. However, it is so important to understand whether you show a certain pattern in closing positions too early or too late. If your timing is good and you do not show a pattern, the average payoff will eventually even out, so you will profit as much as you can from those trades. Similar effects apply to the open timing of your trade. It is arguable that the open timing of a trade may not be as important as the close timing, because with a good close timing, you can make up for a poor open timing, while you cannot do so the other way around. When looking at the charts, please keep your open and close strategy for trades in mind. You may trade based on technical setup, in which you wait for a trend reversal or a trend following signal. Your technical setup should be visible in your data. However, we will talk more after we have a look at example outputs. Let's have a look at the profit if trade is closed earlier or later graph first. As we can see, the profit of the trader would have been highest if the trades were closed 10 minutes earlier, with an average payoff of 2.3 pips versus 1.4 pips in the as-is scenario. So how the trader actually closed the trade? Hence, the trader was too anxious when closing the trades. Moving with the cursor over the bar, you see that the payoff of the trader would have been 15,173 USD if closed 10 minutes later versus 9,505 USD in the as-is scenario. The trader has missed profit of 5,668 USD. On the other hand, if the trader would have closed the trades 10 minutes later than he actually did, the average payoff per trade would have been only 0.1 pips, being 1.3 pips worse compared to the as-is. Summarized, the trader would have been considerably better off closing the trades earlier. An output like this is oftentimes seen if traders close their lost trade too late or waits too long after a reversal in the profit trade and actually loses quite a bit of the unrealized gain. For many traders, an output like this is harder to adjust compared to if you should stop your trades later, because you do have to watch out for wrong closing signals. When working on this, you should closely watch the average performance of your trades. For example, by checking a shorter time frame of outputs to compare your recent result with more long-term result. You'll have to keep an eye on whether closing trades earlier will produce a range of wrong signals in your trading strategy. However, this is different from person to person and strategy to strategy. Oftentimes we see with traders that show both closing the trade earlier and later will yield a better payoff on average. This indicates that you may not have the ideal position closing strategy. Talking to those traders, we can observe that they become insecure as soon as there is a small movement against them in a winning trade. However, if you are following the trend, a small correction in the price is normal. If you are closing the position at the peak of the correction, it will yield a result with both closing the trade earlier and later having a better result. Let's now have a quick look at the opening time. The chart is set up in the same way as the closing time. Here, the trader would have a better result in case the trades would have been opened later. This kind of result can be witnessed a lot with reversal traders, which are impatient on their trade entries. They have been waiting for the trend reversal set up and FOMO, so fear of missing out, into the trade even though the reversal is not yet finished. Yet again, keep close track on whether your adjustment in your trades produce wrong trading signals, or whether your payoff actually increases. You may want to try this with smaller lot size in the beginning to see whether you can actually improve your result. If the output would be that open the trade earlier will give better result, you may be too anxious entering your trades. For example, this is the case if you are waiting for too many trade setup confirmation, actually missing the optimal entry point. As in close timing, an output indicating that opening your trade later would have a better result is arguably easier to adjust, because you do not have to look out for wrong trade signals. Also for open timing, we oftentimes see traders which shows an output in which both open the trade earlier or later will yield a better payoff. Those traders may have difficulties with wrong breakouts, for example. This may be situations if the price quickly moves above a resistance level, the trader enters a long position because of the breakout, but the price quickly falls again. A typical example of falling for a fake out. As a mitigation strategy for those wrong breakouts, you may want to wait for a candle closing above the resistance level to get approval of the breakout. Similar to the timing of the open and close of the trade, it may also be fruitful for you to look at whether your stop loss and take profits are placed well, which will be the topic of another video.